So let's jump right in. Here we have a graph that tracks the performance year to date. So for the first 6.5 months of both the large and the large is the orange, the small is the purple. And I want to draw your attention to the fact that the large cap index is almost flat. It's almost at the same place where it was at the beginning of the year. For the small cap index, though it has also seen a recovery in the last couple of months, it's still about 12% below the start of the year, the level at the start of the year. And, the question looking at this graph is this unusual? Is this normal for there to see this lag between the small cap and the large cap index? I would say that historically, this is well within the norm of the way that the indices behave in periods of market panic and market stress. Okay. Case in point, let me switch to a chart that isolates the Lehman Brothers event back in 0809, the great financial crisis, as we'll remember. And again, here in orange is the large cap. And you see that after the Lehman bankruptcy, the large cap index dropped about 40% through the trough, which was, I think, in March of 09. Small cap, of course, was down even greater amount. It was down almost 50% during that same time frame, right? So again, in periods of panic and stress, when the economy is going or entering a recession or a significant crisis or shock, it's not unusual for small cap to lag large cap on the way down. And similar, we see the same phenomena more recently in the industrial and energy recession of 15 and 16 that was triggered by the devaluation of the Chinese currency in the summer of 15, and which was followed by a dramatic drop in the price of oil, which really hurt the energy patch in the US and the industrial sector that supplies that industry. And again, we see large cap in orange down 12.5% and small cap down 25%, right? So again, another example that it's not unusual for small cap to have deeper troughs during these periods of economic displacement. So what's the logic for holding small cap? Well, the answer goes back to our philosophy at Single Point, which is that for long-term investors, you're going to have a better outcome by having a healthy allocation to small cap, right? And here is a great chart that is a 20-year look back that starts in 2000 and it goes through yesterday, so 20 plus years, 20 and a half years. And here you see the large cap in orange, right? Up 124%, which is a little bit more than doubling, right, of the index. And the small cap at 210%, or just below, basically triples the level at which it was 20 years earlier. So for long holding periods, what we have observed, what the data says is that small cap, even though it's more volatile, is probably a better index in terms of total return and where you're going to end up in say 10, 15 years. And this is really the premise. This is the fundamental basis for allocating client portfolios to the small cap US sector. A little bit of a bumpier ride, but in the end, a better outcome.